Capital gains tax, annual exempt amount up £100 to £11,100 from 11. The rates of tax are the same, 18 and 28. We talked about how it was 18% because 18% is apparently okay. 28% is apparently the break point at which people don't want to pay tax. I don't want to pay tax at 28%, I don't know about anyone else, but apparently scientifically 28% is the rate at which people balk at paying tax. So that's why it's there. And we still have the Entrepreneurs Relief £10 million limit. Now, Entrepreneurs Relief was very interesting when it was introduced because there were never any anti-avoidance provisions in Entrepreneurs Relief. It was a very, very simple relief. There were some simple qualifying conditions and you either got the relief or you didn't. And there was no, as I say, no anti-avoidance provisions. But apparently people have been using it for nefarious purposes, for paying tax at a lower rate than they should have been. So we're beginning to get some anti-avoidance stuff come in. This first lot came in with the autumn statement, and basically there was a jolly good wheeze, and I'm afraid that we advised clients to do it when it was appropriate to them. If you started business as an unincorporated business and then incorporated your business, obviously this is only for new businesses, then you were able to effectively sell your business to your company and create a balance which you could be paid over time at 10%. There's nothing particularly controversial about that. You've always been able, in effect, to do that. The controversial thing was the 10% rate of tax, not the fact that it was capital gains tax. And the government said, no, we don't like that. If you own the company afterwards and you owned the business before, no, you can't have Entrepreneurs Relief. Okay, fair enough. So I can see the logic behind that because, in effect, commercially, you're the same before and after. So, yeah, fair enough. They have pulled that back a bit because they realised that some people may not be in the company but were in the partnership. And for those that don't carry over, they can actually claim Entrepreneurs Relief now. So that's a bit of a loosening that came yesterday. And that's perfectly reasonable when you think about it. If someone's leaving, well, why not? They should take their money. The flip side of all that, and the reason why it was so good, of course, before, was that companies, when they acquire goodwill, can write that off against tax. I mean, there are some limits, but generally they can write off depreciation of goodwill against corporation tax bills. And they were able to do that when the business was acquired from a connected person, and you can't do that anymore. So from last December, you can't do that. So that sort of squared that circle. So that really changes the way that we think very often now about incorporating businesses. On the flip side, there was always another problem where you would sell your business and then realise a gain and then defer it potentially into assets which then qualify for some other kind of relief, EIS relief, for example. And the problem was always that if you did that, you weren't going to be entitled to Entrepreneurs Relief because the nature of your asset had changed. It had changed from being an asset which might have qualified to one that didn't. And the government's basically saying, well, okay, we realise that's a disincentive. So if you sell shares that qualified for Entrepreneurs Relief and then you roll over, in effect, those gains into an EIS company, you can take that qualification for Entrepreneurs Relief forward into your new investment and you don't lose it. So you don't have the silly situation where you could have had 10%, and because you've rolled over and done something the government wants you to do, to invest in a company that needs money, that you then have to pay 28% on the way out. So all very sensible. That came in the autumn statement. This is where people have been a bit naughty. There was a concept, or there is a concept, and this used to apply with the old retirement relief as well, that where you come to retire from your business, which is what retirement relief was about. Entrepreneurs relief is not actually about retirement, but that was the basic fundamental for it. It's about disposing of a business and coming out of it. But you don't actually have to come out of a business under entrepreneurs relief. So the idea was that sometimes you own, for example, shares in a company, or you are a participator in a partnership, and you make a disposal in the partnership, but at the same time you have an asset, usually a property, which the partnership or the company has been using for the purposes of its trade. And the associated disposal rule allowed, assuming you didn't charge a full rent and various other things, you to get entrepreneurs relief on the side of the property that was used by the business. And of course, because there has to be a connection between the associated disposal and a disposal of a part of the business, what people were doing was they were, in a perhaps opportunistic way, selling the property and disposing of maybe one share in their business to somebody else. So they qualified for entrepreneurs relief. And what the government said, well, that's just not good enough. That's just not the idea of this. You've got to make a proper disposal of part of your business to a third party. So they're saying you've got to sell at least 5% of the shares or the business at the same time as you make the associated disposal. In fact, very few associated disposals ever qualify for entrepreneurs relief because most people want to get a full rent for their property from their business. If you do that, you don't get entrepreneurs relief. So basically you'd have to rent the property to the business for no rent or a low rent in order to get the associated disposal entrepreneurs relief. So it's actually fairly limited, but you could see people were obviously setting this up as some kind of a tax scheme. There was also apparently situations where people were putting money into holding entities that were then investing in trading companies. And the government has said that where the company that's invested in has no trade of its own, but it simply invests in others. And by that they don't mean 100% holding company of a trading company. They mean a company which has a series of small investments in other trading entities. Then you can't get entrepreneurs relief. They don't like it. It's not what it's about. So if you have that structure, you need to look at it. Residential property. There's a typo on the slide, so I will tell you what it means. Basically, non-residents didn't used to pay tax on property or other assets in the UK. With effect from this 6th of April, UK residential property is now taxable regardless of where you reside, which is a change in our capital gains tax rules. If you are a non-resident and you own an existing property, you can effectively rebase your property to current value. The government's notes make it very clear that the person is responsible for getting their own valuation and it being right and all the rest of it, just as we all are. But in essence, it's only gains from 6th of April that will fall into this new tax charge. No withholding at source, which does apply in lots of other jurisdictions. That would be too difficult and it's anti-British. So it will be self-assessment. We'll come on to self-assessment in a while because apparently it's going to be abolished. You know, that's going to make things a bit more complicated for non-resident persons, but probably fair enough. Doesn't apply to commercial property, by the way, only applies to residential. Doesn't apply to commercial property because nobody makes any money on it.